Hey everybody, it's Tom. Welcome back to the channel. I'm sure everybody knows by now that Trump has been elected the next president of the United States, and that raises a lot of questions about what this means for your money, the markets, and where should you be putting your investments right now. So in this video, we're diving into the data to see how past elections have impacted markets, where major institutions are moving their money today, and most importantly, what you can do with this information to maximize your own returns as we head into 2025. So first, let's take a closer look at what history tells us about elections and the stock market. Many believe that the stock market's performance depends on who's sitting in the Oval Office. And a lot of people assume that if their preferred candidate wins, the market will soar, and if the other side takes it, the market's going to crash. But the reality is, it's a lot more nuanced than that, and honestly, not nearly as dramatic as most headlines make it out to be. Looking back to 1957, the data shows that markets have performed well under both Republican and Democratic presidents. On average, Republican presidents have delivered about a 10.2% annual market return, while Democratic presidents come in slightly lower at 9.3%. Now, when you take a step back and look at the big picture, that difference isn't all that significant. The market has a long history of going up over time, regardless of who's in the White House. So, if the president's impact on long term market performance isn't as big as most people think, who actually holds more power to move the markets? And the answer is Congress. Congress controls how much money is spent, how it's taxed, and how regulations are created. These are the decisions that directly impact businesses and, by extension, the market as a whole. And the data backs this up. When there was a Democratic president with a divided Congress, returns averaged at a 13.6%, and when there was a Republican president with a divided Congress, returns averaged at 13.7%. Think about it. When there is government gridlock, how many major policy changes actually get passed? Not that many. This lack of sweeping change creates a predictable environment, and that's exactly what businesses thrive on. Stability allows companies to plan long term and make strategic investments and focus on growth without worrying about sudden shifts in taxes, regulations, and spending priorities. Rather than returns happening because of the specific party, the stock market returns are primarily driven by what's actually happening in the economy. Things like corporate earnings, consumer spending, and innovation in technology. Businesses tend to adapt to the environment they're in, and as long as they can grow, the markets tend to follow. But what's different about 2025 is that we're not dealing with a divided Congress. This time, Republicans control both the Senate and the House. That kind of alignment could lead to some major changes. For example, Trump has emphasized deregulating oil and gas, loosening financial regulations, increased spending in certain sectors like energy and defense, and imposing tariffs. And those changes could have a more immediate and noticeable impact on the market. Now, for investors, this setup could mean huge opportunities, but you've got to know where to look. And that brings us to an even bigger question: where is the smart money going? So let's take a closer look at what the world's largest asset manager, BlackRock, is doing right now. BlackRock didn't waste any time reacting to this new political landscape. And just a few days after the election, they moved billions of dollars to capitalize on the opportunities they see in this new environment. According to Bloomberg, BlackRock saw record inflows into their momentum ETFs, which focus on growth and stocks, and significant outflows from bond ETFs. This is because they're betting big on businesses bouncing back now that the uncertainty of the election is behind us. But that's not all. BlackRock isn't just focusing on traditional stocks. They're also making big moves into the Bitcoin space. Their newly launched Bitcoin ETF has already surpassed their 20-year-old gold ETF in assets under management. That's a massive shift. So what does this all mean for you as an investor? Let's break this down. First, let's talk about momentum stocks. BlackRock is putting billions in this space because they believe businesses are ready to grow again. One of BlackRock's head portfolio managers stated, "The uncertainty discount embedded in market prices should begin to thaw as businesses and investors regain their footing and seek to execute on delayed strategic initiatives." So during the election, many companies paused spending. They held off on making the big decisions and waiting to see who'd actually win. But now that that uncertainty is gone, they're ready to allocate capital forward and towards growth. And usually when businesses grow, their stock prices tend to follow. Okay, second, let's talk about interest rates. BlackRock is predicting rates will keep dropping. Lower rates make borrowing cheaper, which is great for businesses, especially smaller companies and startups that rely on outside funding. When borrowing is affordable, they can expand faster, which boosts their stock performance. That's why we're seeing money flow into momentum stocks and out of bonds. And then there's Bitcoin. I mentioned BlackRock's Bitcoin ETF has more assets under management now than their 20-year-old gold ETF. And just to put this into perspective, after the election, Bitcoin ETFs across the US saw over $1.3 billion in inflows in a single day. Out of that, BlackRock's Bitcoin ETF accounted for $1.1 billion of the total. That means BlackRock's ETF took the lion's share of market activity, signaling enormous confidence from institutional investors. So what's driving this shift? Part of it, I think, is the growing acceptance of Bitcoin as a legitimate asset class, especially among institutions, and Trump pledging to position the United States as a global hub for digital asset development. BlackRock also sees Bitcoin as a viable alternative to traditional inflation hedges like gold, which is why we're seeing this level of interest. And with Bitcoin nearing record highs, close to $90,000 per coin, this ETF offers a way for investors to gain exposure without having to hold the actual cryptocurrency, which honestly can be complex and risky for most people. So with all this happening, what can you do to take advantage of these trends? Real quick, before we continue, I want to take a moment to emphasize that all of the investments we're discussing today, it all comes with risks. There's no guarantee you'll make money, so it's crucial to do your own research. The information in this video is meant for educational purposes only, so please do your own due diligence before making any financial decisions. All right, so what can you do to capitalize on some of these opportunities? First, stay invested for the long term. Trying to time the market around elections is a risky game. The data is very clear on this. Staying invested consistently, regardless of who is in the office, beats sitting on the sidelines. Play the long game and keep your eyes on the big picture. Second, diversify across growth sectors. So consider researching momentum stocks and ETFs that target areas like tech, defense, and renewable energy. These sectors seem to be well positioned to grow under current policies. Third is to keep an eye on interest rates. Falling rates can favor growth stocks and undervalued small caps. So if you're thinking about rebalancing your portfolio, this could be a key area to keep your eye on. And fourth, educate yourself on cryptocurrency. Cryptocurrency is rapidly gaining traction and becoming a more accepted part of the financial world. However, there's still a significant knowledge gap when it comes to understanding how it works and how to approach it as an investment. While investing in crypto can be risky, Bitcoin ETFs provide a simpler way to gain exposure to this growing asset class without the complexities of owning cryptocurrency directly. And with that said, it's important to proceed with caution. This space remains highly volatile, and thorough research will be really important before you dive in. And finally, focus on what you can control. Don't let political noise distract you because it's never going to go away. Stick to your plan, cut unnecessary expenses, and make every dollar count. It's easy to get caught up in overthinking things, but staying focused is what really matters. Now, if you're thinking, Tom, this all sounds great, but I don't have extra cash to invest right now, I've got you covered. Check out my payday routine video. It's packed with practical tips to take control of your finances, eliminate stress, and start building wealth step by step. So click here to watch it now, and I'll see you over there.